We're analyzing Enterprise Product Partners stock ticker EPD to see if it's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for EPD. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Enterprise Products Partners for your stock portfolio. Before we get into these valuable metrics, let's understand EPD stock performance. Right now, Enterprise Product Partners trades for $26.68 per share. Year to date, their stock price is up 10%. Right now, they pay a huge 7.27% dividend yield. This is in addition to their returns in their stock price. In the last 5 years, their stock is down 9.5% overall. In the last 10 years, this is down 12%. Going back before the global financial crisis, Enterprise Product Partners is compounding at just under 4% annually. Keep in mind their average dividend yield is in addition to these returns. Enterprise Product Partners trades $1 below their 52-week high. The company's up about $3 from their 52-week low. Not a lot of change in their stock price over this time. About 0.5% of their shares are sold short. Enterprise Product Partners is a big company. They have nearly a $58 billion market cap and an $88 billion enterprise value. But the burning question is, why should we be paying close attention to Enterprise Product Partners? Enterprise Product Partners is a master limited partnership that transports and processes natural gas liquids, crude oil, refined products, and petrochemicals. It's one of the largest midstream companies with operations servicing most producing regions in the lower 48 states. Enterprise is particularly dominant in the natural gas liquids market. It's one of the few master limited partnerships that provides midstream services across the full hydrocarbon value chain. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. The average business earns about a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Enterprise Product Partners earns very stable, very steady returns on capital, right around the 10% mark in all of these years. Indeed, when we average out their returns on capital, they earn 10.3% returns in a given year. While this is solidly above average, this is several percentage points below the benchmark we're looking for, meaning this is an X on metric number 1 for Enterprise Product Partners. Metric number 2, we're looking for growth. Typically, we want to see revenue, net income, and free cash flow growth. As an MLP, Enterprise Product Partners' free cash flows are really what matters. Their revenues and net incomes can vary year to year based on the nature of the business. In the last 5 years, including up until today, Enterprise Product Partners has grown their free cash flows by 2.5 times. This is huge growth for the business. They've generated a lot of cash flow in all 5 of these years. This is a big check on metric number 2. While less telling, they've also grown their revenues by 58% and their earnings have grown by 34%. Growth across the board here for Enterprise Product Partners. Metric number 3, we're looking for shares outstanding to be decreasing. In this time, Enterprise Product Partners has kept their shares outstanding pretty much flat. They've just barely diluted shareholders, issuing about 0.5 percentage points additional shares. This is shareholder dilution nonetheless, however, meaning this is an X on metric number 3. This dilution is far below what some other peers have done. Metric number 4, we're putting our last 2 metrics together. We're looking for free cash flow per share growth in the last 5 years, with just tiny shareholder dilution and their free cash flows growing by 2.5 times. This has led to free cash flow per share growth. This is a check on metric number 4. To recap where we stand currently, we're split evenly. Through 4 metrics, we have 2 checks and 2 X's for Enterprise Product Partners. How will the company do in the rest of our analysis? During recessions, it's overly levered businesses that are at the greatest risk of losses. In metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in the last 5 years. Enterprise Product Partners has kept their net debt around the same throughout this time. They ended their last year with $28.6 billion of net debt. Right now, they have about $29 billion worth of net debt. In their last 5 fiscal years, they've generated $18.9 billion worth of free cash flow. While that's a healthy amount, and it's really upticked in their last several years, it's coming in below their net debt position, meaning this is an X on metric number 5. This may or may not be an issue for the company. Midstream businesses tend to be more highly levered than other other companies. This is in part due to the predictable nature of their business and based on their large amount of fixed assets. Dig into the company's filings to learn more about how their debt is structured. Before we get to our valuation methods, it's time for our bonus. As our bonus, we're looking at Enterprise Product Partners' dividend profile. Right now, EPD pays a huge 7.27% dividend yield. That's way above the dividend yield from an S&P 500 ETF, but people make mistakes all the time by blindly chasing dividends. We want Enterprise Product Partners to support their dividends using their free cash flows. That's only been the case in 2 of these last 5 fiscal years. It is the case today. Even still, Enterprise Product Partners has grown their dividends in all 5 of these years. While we'd rather see that they supported their dividend payouts in all 5 years, it's at least good that they're supporting them recently and that they are supporting them today as well. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. This is a check on our bonus. Enterprise Product Partners doesn't break out all of their maintenance capex like some other midstream businesses. Our more conservative method of calculating free cash flows as cash from operations minus all capital expenditures may be unfairly penalizing the business for some of their growth capital expenditures, meaning Enterprise Product Partners may be more cash generative than we're giving them credit for. That's something to dig in and learn more about if you're interested in the business. The big metric of them all, metric number 6, we want Enterprise Product Partners' average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Enterprise Product Partners. Right now, EPD has about an $88 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at EPD similar to it being a private company. We learned in their last 5 years that they've generated just under $19 billion worth of free cash flow, meaning in an average year they generate about $3.77 billion worth of free cash flow. When that's divided by their $88 billion enterprise value, we get about a 4.33% average free cash flow to enterprise value yield. On a current basis, Enterprise Product Partners generated $5.2 billion of free cash flow in their last 12 months. When that's divided by their $88 billion enterprise value, we get about a 6% current free cash flow to enterprise value yield. Both of these are split on the risk premium we're looking for, though they are above the yield of the 10-year treasury. Because we're looking at this on an average, for Enterprise Product Partners coming in on metric number 6, this is an X. Don't just throw the business out. We still need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Enterprise Product Partners, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of their last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for the company. Assuming they grow their 3-year free cash flows at a rate of 3% annually for the next 10 years, then in the following decade, assuming that these just grow at 1% annually, if we add in their tangible book value, which gives an estimate of their net worth, if we want a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, if today's valuation multiples are the same in 20 years, an estimate of Enterprise Product Partners' fair value per share is around $25. That's just about $2 below their current stock price. While there's not a lot of movement in their stock price, this is pretty close. Keep in mind some key points. Enterprise Product Partners has a low degree of business predictability in their past. This could affect our assumptions and be the case going forward. The company's done quite well from 2021 onwards. You'd have to make sure that that would be sustainable going forward into the future. Also, this discount rate is an estimate of total returns to shareholders based on their free cash flows. It already includes their dividend yield and any gains in their stock price. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Enterprise Product Partners, but we have to address something first. We've covered the numbers, but the qualitative factors may be even more important for EPD. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, Enterprise's marketing activities let it extract additional fees from its asset base while providing insights into each of its markets. Number 2, its expansion into petrochemical activities insulates Enterprise from midstream cyclicality. Number 3, as the largest player in the natural gas liquids market, Enterprise is most leveraged to petrochemical demand in the Gulf Coast and international markets. But we'd be remiss if we didn't cover the negatives of the company as well, looking at the factors supporting a short thesis. Number 1, without substantial growth in US hydrocarbons, more of Enterprise's assets risk being underutilized and thus seeing lower revenues and fees. Number 2, the promise of a large increase in natural gas liquids demand from China and India in particular never seems to materialize, and Enterprise can be left holding the bag with export facilities. Number 3, Enterprise's marketing operations depend on differential spreads that could continue to narrow without investments by Enterprise and third parties to spur demand. There you have it for a balanced perspective of some of the qualitative factors of Enterprise's business. Now it's time to give our rating. In analyzing Enterprise Product Partners, stock ticker EPD, we learned this midstream natural gas transportation company earns above average returns on capital. They've grown by a lot in their last 5 years, including on a per share basis. While they do use more leverage than their free cash flows can support, that's including both their growth and their maintenance capex. Even still, it looks like they're using lower amounts of leverage than some peers. Enterprise Product Partners has also grown their dividend. They've supported this dividend growth since 2021 and they currently support it today. It's worth reiterating this analysis is not financial advice. Compared to the yield of the 10-year treasury, Enterprise Product Partners' free cash flow to enterprise value yields may or may not look attractive. When we performed our discounted cash flow analysis, if today's valuations are the same 20 years from now based on those assumptions, and if you want a 15% rate of return, an estimate of Enterprise Products Partners' fair value per share is around $25. That's just below their current stock price, well within the range of where they've been at in their last 52 weeks. Looking at all the factors of our analysis, Enterprise Products Partners looks like a strong candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about EPD, and let me know what business to cover next in the comments below. Thanks for learning about Enterprise Products Partners with me, and have a great day.